The banking system has accumulated $2.2 trillion in unrealized losses inside of the last 12 months, and these losses are only going to continue.
The US saw its biggest banking collapse since the global financial crisis.
Collapse of another American bank.
The second biggest bank collapse in U.S. history.
Second largest bank collapse in U.S. history.
When we look at what's happening behind the scenes, we lift the hood, we can see a massive, massive problem that's unfolding that's going to hit and impact all of American consumers. And nobody's talking about this. I'm going to break it down for you clearly in this video because what I'm going to show you is shocking. Please hit that like button. When you hit the like button, YouTube's going to share this content to educate more people about what's actually going on in today's economy. Also, today's video is sponsored by my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have bad credit and you want to change that, you want to position yourself for what I believe is going to be the greatest wealth transfer of all time, we would love to give you a free strategy session at GreatCreditFast.com. Take a look at this. So, the U.S. banking system accumulated $2.2 trillion in unrealized losses over the past 12 months. This is from Stanford University. Well, let's look at where the everyday consumer is. The everyday consumer, from Party City to Bed Bath & Beyond, bankruptcies just hit the highest level since the Great Recession. So you have record high bankruptcies, and we have a consumer that has less money than they've had since the Great Financial Crisis. So what does this mean for banks? Banks are sitting on massive losses because not only are their loans performing very poorly, but consumers have less money inside of their banks. And so they have less money to invest. And so every single day gets harder and harder and harder for these banking institutions to stay in business. Just four banks have a total of $205 billion in unrealized losses. And these banks, Bank of America, Wells Fargo, JP Morgan Chase, Citigroup. So just those banks, almost $250 billion in losses. Now, most U.S. banks are technically near insolvency. This is back in March, right? This is what they were saying in March. Things have changed since March. 200 banks face the same risk. Well, back then, about 2 or 3 weeks before SVB, I put a video out saying, big problems coming for banks. Big problems coming for banks. And you can look at the date, you can match the date. I called it that was going to happen. Well, this is what I think is going to happen next. People are leaning heavily on FDIC. They're like, oh, FDIC insurance, we have this insurance, I'm fine. I'm fine if something happens, I got this insurance. Well, FDIC insurance can only insure 1.27% of deposits, 1.27% of deposits. So if you have $100 in that bank, $100 in that bank, they'd be able to insure $1.27 of it, right? $1.27. And that's considering that if everything was fair and equal. When has anything ever been fair and equal? So you have Mr. Billionaire up top, and you'll have Sally and Tom, and you'll have Mike and all these small business owners and everyday hardworking Americans below. And if things hit the fan, what are they going to do? Mr. Billionaire is going to probably be made whole, and everyone below is probably going to have a very rude awakening. And this is not an opinion. This is fact. Like Janet Yellen came out saying, you know what? The banking system is completely fine. Everything is great. Everything is strong. Jerome Powell came out saying the same thing. It's sound and resilient. Sound and resilient. Man, just like inflation's transitory. They said that 2 years ago. How's that working out for everybody? SVB customers tried to withdraw nearly all bank deposits over 2 days. Well, they have a solution for these bank runs and for these potential bank runs that could be coming. Nobody's going to like it. SVB's shares fall sharply after $1.8 billion in surprise losses. Now, how does this actually work? They have these unrealized losses, and they don't have to realize them until they need to sell off assets like SVB. Well, when they really have their feet to the fire, that's what happens. When they really step into these big problems, they're going to have to start selling at these big losses. And when they do, the house of cards comes collapsing down. And these banks, they're already really exposed to a point to where there's no hiding from this anymore. This gentleman right here says, could government stop you from pulling cash from banks? Money expert lays out his panic scenario. And he says that where the Treasury and the Fed may have to come in and actually restrict your right as a U.S. citizen to pull money out of the banking sector. And he said that because if they did that, then they would have the ability to restrict the collapse, right? They'd be able to hold back some of the pain in the banking system. Another person came on saying that, Macro Guru, the U.S. government may restrict your right to pull money out of banks as panic grows. Here's what he likes for protection, plus 2 other shock-proof assets, two other shock-proof assets. Well, look what the FDIC said. Look what the FDIC said. So you can kind of get an idea of where banks are, where the everyday consumer is, the everyday small business, where personal savings rates are, and where commercial real estate's headed and where their actual balance sheets are. Community banks, which represent 91% of insured institutions, reported quarterly net income of $7 billion in first quarter of 2023, down $306 million from 1 quarter ago. Lower net interest income and non-interest rate income exceeded decline in losses on the sale of securities. Provisions for credit losses and non-interest expense. The community bank pre-tax return on average asset ratios fell 21 basis points from 1 quarter ago to 1.27%. The Deposit Insurance Fund, DIF, balance decreased by $12.1 billion from $116 billion. The vast majority of the decline in the DIF was for a loss provision, which subtracted $16.4 billion from the DIF. Other costs included $1.7 billion unrealized loss in the sale of investments and $508 million in operational expenses. Assessment revenue of $3.3 billion was the largest source of income. A net decrease in unrealized losses on available for sale securities of $2.5 billion, interest earned on investments of $661 million, and other miscellaneous expenses $12 million. Also, income of $12 million also partially offset the decline in fund balance. Now, here's one thing that I think nobody's really thinking about when they think about the banking system, and it's student loans. People aren't realizing what actually happened over the last 3 years. Think about this. In 2020, in 2021, they sent out tons of checks. They had PPP loans and small business loans and all these grants, all of these opportunities being sent out to small businesses. And you also had a lot of people not paying bills because you had eviction moratoriums, you had forbearance moratoriums, you had student loan extensions, and they're still in place right now. So what did people do? They had more money than ever. Borrowing money was cheaper than ever, and they didn't have to pay expenses. Right? They didn't have to pay their debt obligations. So people went out there and borrowed tons and tons and tons of money. But now the cost to service that debt is getting more expensive, yet real wages are starting to come down. And as that is happening, student loans are going to soon become due again. So what does this mean? It means more pressure on banks because they're going to start suffering more and more and more losses on all their loans, especially when we're looking at autos. Auto loans are a huge problem, $1.6 trillion in auto loans. It's a big number. $1.7 trillion in student loans, $1 trillion in credit card debt, all of which equates to a massive, massive problem. But I still don't think that those problems are half as big as the problems that are coming for commercial real estate. Commercial real estate, I think, is going to be one of the problems that is going to rock regional banks. And the reason for it is that regionals, these small banks, small local lending institutions, they're holding 70% of all commercial loans. 70. That's a huge figure. That is a huge figure. And you look at what these commercial real estate loans are up to, $2.9 trillion. Half of that $2.9 trillion has to get refinanced in the next 18 months, right? So you're talking $1.5 trillion in commercial properties that have to get refied. And these regional banks are holding about $1 trillion of it, right? So they have to refinance all of this debt at much higher interest rates. And lenders, they're stepping into a really hard position because the investors, when they bought these properties, they're just handing the keys back. Look at this. As loan maturity dates approach, office landlords across the city are being forced to either hand back the keys to the lender or sell their properties at a loss. Why prices of NYC office and rent stabilized buildings are falling, right? All these more office owners are selling office. You look at this right here, more office distressed properties simply choose to walk away. The reason for it is when you buy in a commercial property, whether it be office or multifamily, whatever it may be, when you buy a commercial deal 5 units and above, you're basically buying that deal based on the income that asset generates. And so you're not putting your credit score on the line. You're not personally guaranteeing it. The asset is guaranteeing it. And so when the asset goes from a 3% interest rate where the deal is cash flowing to now debt is 7%, and now the deal's running into the reds, tens of thousands or hundreds of thousands a month, people are just saying, you know what? I would have to come out of pocket hundreds of thousands or millions of dollars just to be able to get the refinance, and even then, it still doesn't make sense to do it. I'm just giving back the keys. I'm gonna, I'll step up to the plate again. I'll swing the bat later when it makes more sense. You're gonna start seeing this across the board. But what does this all mean? it means a lot of problems are headed towards the banking institution, whether it be small or regional banks, I believe, are going to get hit hardest. And I think large banks are going to step in and they're going to start acquiring, like JP Morgan did with First Republic. That's what's going to happen. They're going to do this because they're able to acquire more banks. If it's under a financially distressed situation, like JP Morgan Chase, they're able to do it because there's a small provision in there that says that right now they're not allowed to get bigger than 10% of the entire market. But if it's a distressed situation, they're able to go out there and acquire more and more and more banks. So that's what I think we're walking into. We're walking into a mass consolidation of banks. We're walking into a much tighter lending requirement. I mean, they're talking about that. They've been talking about this right now for maybe 2 months, 3 months, saying that U.S. banks tighten lending standards to small business and consumers. They've been talking about this a month ago. They've been talking about this because it's going to get worse. It's going to get worse. As banks start realizing more and more losses, they're going to look at every single loan much more carefully. And they're going to say, do I really want to give this guy or girl or person a loan? Well, it's really going to depend on their cash. It's going to depend on their credit. It's going to depend on the amount of risk that they're going to offer. And if it doesn't make sense to them, they're not going to lend that money. And so this is why I've been talking a lot about this on this channel, that credit is so important. Having cash is so important. Being positioned correctly is so important because we are in the greatest wealth transfer of all time. We are. There's no doubt about it. I mean, the writing's all over the wall. Look at what's going on. The middle class are getting absolutely crushed over the last couple of years, and I think the next few years are going to be way worse. But for smart and savvy investors and entrepreneurs, they're looking at the writing on the wall and they're seeing exactly what's happening. What do you think about this entire situation? Drop below, hit the like button, add me on IG. And if you want to fix your credit, we would love to help you and give you a free strategy session at my company, greatcreditfast.com. That's greatcreditfast.com. I'll catch you guys in the next video.